great to have you with us. Let's start the hour with a quick update on what's happening with Canada's economy. Canadian consumers appear to have embraced falling interest rates, ending the holiday season with the strongest spending in nearly 2 years. As we mentioned, Stats Canada provided two numbers today. Yes, the November numbers, but the market is always forward-looking. So the more important piece of news is December, and the early read on that would suggest retailers saw an increase of around 1.5%, and that would be the strongest monthly pace since January of 2023. Now, certainly there's been a lot of talk about the federal sales tax holiday, which seems to have boosted purchasing in some products and some restaurants, for example. But at the same time, this lower interest rate environment might be spurring on some buying activity. Now, against that backdrop, we are getting ready for another interest rate decision by the Bank of Canada. We will see what ultimately they do, especially in the face of looming uncertainties surrounding tariffs directed at Canada from the United States. For more on the Canadian economy, we're joined now by Royce Mendes. He's Managing Director and Head of Macro Strategy at Desjardins. Royce, nice to see you. I guess if we start with the latest data for Canada's economy, what's happening on the retail side, any takeaways with the numbers from Stats Canada today?
I'm not surprised that retail sales were up significantly in December after showing weakness in November. Obviously, a lot of Canadians were looking ahead to that GST tax holiday that they received in the middle of the final month of 2024 and delayed their purchases. And so I am concerned that the underlying momentum is not as robust as that December number suggests. It suggests that maybe there was some delaying in purchases and maybe also some pulling forward of purchases from 2025 into December to take advantage of those lower taxes. Another thing that was happening in the economy last year was that after Donald Trump's election, a lot of U.S. businesses started to import a lot of Canadian goods. That's because they wanted to get ahead of tariffs and build inventory so that if tariffs are raised, they don't have to pay them at least for a little while they draw down on that inventory and sell to their customers in the U.S. So the economy might have been in at least a temporarily better state at the end of last year and early into this year. But looking ahead in the months and quarters to come, it's obviously a much more precarious situation.
Well, let's talk about that. Give us a sense on how you're seeing things play out from here. I mentioned we're getting awfully close to the next interest rate decision by the Bank of Canada. It's hard not to try to factor in the tariff threat that is looming, and I'm sure that the central bank has to consider that. But there's all sorts of complications. I mean, the fact that our Canadian dollar is already extremely weak is something else to consider. Give us a sense on what you think the Bank of Canada is going to be doing with all of these data points.
Look, I think if the Bank of Canada looks at the Canadian dollar, obviously it's weaker than it has been in some time, but it reflects the fact that the Canadian economy is in a difficult position and the outlook for the economy is not great. So it basically reflects domestic fundamentals. I don't think the Bank of Canada is going to have much of a problem with that. When the Bank of Canada thinks of the possibility of tariffs, the potential for a major economic hit, tipping the economy into recession, is very high. The possibility that tariffs and retaliatory tariffs turn into sustainably higher inflation, in my opinion, is low. And that tells me the greater the risk of tariffs, the more the Bank of Canada should be cutting. I'm not saying that retaliatory tariffs and the currency depreciation won't translate into some higher goods prices. It's just that the Bank of Canada will tend to look through that. They'll look at that as a one-time increase in the price level, and they'll be more focused on the potentially much higher unemployment rate and the growing slack in the domestic economy when they come to the decision, I think, next week to cut interest rates another 25 basis points.
You know, I want to follow on that and see. It's hard, right? This is less tangible, but the threat of tariffs seems to already be influencing the actions of organizations, global ones, including some that have been investing in Canada. You know, I think about in the auto sector, what Stellantis is doing. It feels like they're feeling pressure to focus on America rather than Canada, where they had made a sizable investment. Does it take the actual official tariffs hitting, do you think, for Canada's economy to take a hit just from this looming uncertainty?
Well, in a perverse way, as I said, right now, the economy is actually benefiting from these higher exports to the U.S. as U.S. businesses build inventory. But as you said, the business uncertainty and the delaying or canceling of business investment is offsetting some of that growth. And as we move forward in time, inventories will be built up enough that businesses won't need to do that anymore, and we'll lose that tailwind, and we'll be left with the lower level of business activity in this country. I think, you know, whatever happens, the sooner it happens, maybe actually the better, because we can remove that uncertainty and work towards coming to a conclusion. I know everyone is talking about, you know, what the upside risk is to the unemployment rate if we get hit with 25% tariffs across the board. I think the more important thing for investors is to focus on what a deal looks like, and what that deal looks like for the medium-term outlook for the Canadian economy and businesses operating in this country. Does Donald Trump want more of our resources? Does he want us to spend more on defense? Does he want us to do more at the border? Does he want all of these things? What does that mean for the businesses in this country and the trajectory of the equities associated with those businesses? That's what I'm more focused on than the near-term, maybe volatility around what I believe will likely be a temporary tariff on Canadian exports.